The 29th of October, 1934, 9:47 a.m. Lucky Luciano walked into the marble lobby of J.P. Morgan and Company on Wall Street, carrying nothing but a briefcase and a reputation. By 11:30 a.m., he owned controlling interests in 10 major corporations, held mortgages on 12 office buildings, and had effective control over 3 banks. He didn't spend a single dollar. He didn't write a single check. He didn't even open his briefcase. Instead, Lucky Luciano had discovered something that would reshape organized crime forever. In a world drowning in debt, the man who could make problems disappear was worth more than the man who could make payments. To understand how Lucky Luciano conquered Wall Street without firing a shot or spending a cent, you need to understand what the Great Depression had done to America's financial elite. By 1934, the stock market crash of 1929 had been devastating, but 5 years of economic collapse had created something worse than poverty. It had created desperation among people who had never known desperation before. The titans of Wall Street, the banking families who had controlled American finance for generations, were drowning in a sea of bad debt, failed investments, and terrified creditors. These weren't street criminals who understood violence and intimidation. These were educated men in expensive suits who had spent their lives believing that money could solve any problem. Now they were discovering what happened when the money ran out and the problems remained. By October 1934, Lucky Luciano had been studying Wall Street's vulnerabilities for 18 months, not through financial analysis or market research, but through the same intelligence network that had made him the most powerful crime boss in America. Lucky understood that every business, legal or illegal, operated on the same fundamental principles: leverage, intimidation, and the management of risk. The financial district was full of men who owed money they couldn't pay, who had promised returns they couldn't deliver, who had made commitments they couldn't honor. These men needed solutions that banks couldn't provide and lawyers couldn't arrange. They needed someone who could make their problems disappear through methods that didn't appear in any business school textbook. Lucky's entry into legitimate finance began with a conversation in September 1934. Harrison Rothschild III, heir to a banking fortune that had been decimated by the Depression, was sitting in the back booth of an Italian restaurant on Mulberry Street, looking like a man attending his own funeral. Rothschild wasn't there by choice. He was there because Mylansky had arranged the meeting, and Mylansky was one of the few people in New York who might be able to help with Rothschild's problem. Rothschild owed $2.3 million to various creditors, money that his family's bank simply didn't have. Worse, one of those creditors was Antonino Scalise, a loan shark who had connections to families that didn't accept bankruptcy as an excuse for non-payment. Rothschild needed $2.3 million, or he needed Scalise to forget about the debt. Since he didn't have the money, he was hoping Lansky could arrange the forgetting. "Mr. Rothschild," Lucky said, sliding into the booth across from the nervous banker, "Meyer tells me you have a cash flow problem." Cash flow problem was like calling the Titanic a navigation error, but Rothschild nodded. "Mr. Luciano, I need someone to speak with Mr. Scalise about extending the terms of our arrangement." Lucky smiled, not a friendly smile, a business smile. "Harrison, may I call you Harrison? You are thinking about this problem wrong. You don't need Scalise to extend your loan. You need Scalise to forgive your loan. And you don't need to pay money. You don't have. You need to offer value. You do have." Rothschild was confused. His family's bank was failing. Their investments were worthless. Their real estate was mortgaged beyond its value. What value could he possibly offer? "Your bank," Lucky continued, "processes transactions for how many businesses?" "About 400 legitimate accounts," Rothschild replied carefully. And those businesses trust your bank because your family name means something in this city. That trust, Harrison, that reputation, that is worth more than money. That is worth everything. Lucky's proposition was elegantly simple. Rothschild's bank would become a legitimate front for certain financial operations that required the appearance of respectability. Nothing obviously illegal. Nothing that would attract federal attention, just routine business transactions that happened to involve people who preferred privacy in their financial affairs. In exchange, Lucky would not only arrange for Scalise to forget the $2.3 million debt, he would also provide the bank with enough legitimate business to restore its profitability. Rothschild would keep his family bank, his reputation, and his life. Lucky would gain access to Wall Street's financial infrastructure and the respectable appearance it provided. Rothschild agreed within minutes. He didn't have a choice, but more importantly, he didn't want a choice. Lucky's solution allowed him to save face, protect his family's legacy, and solve his immediate problem without admitting failure or declaring bankruptcy. The Rothschild arrangement became Lucky's template for conquering Wall Street. Over the next month, he identified 12 other financial institutions that were facing similar problems: too much debt, too little capital, too many creditors who couldn't be satisfied through conventional means. Each institution offered Lucky something different. Rothschild's bank provided transaction processing and financial legitimacy. Morrison Securities offered stock trading and investment services. Atlantic Trust Company controlled commercial real estate financing. Hudson Valley Insurance wrote policies for businesses that needed coverage but couldn't qualify for mainstream insurance. Lucky's approach was consistent but customized for each target. He never offered money because money was what these men lacked. Instead, he offered solutions to problems that money couldn't solve: creditors who would disappear, competitors who would face unexpected difficulties, regulatory problems that would resolve themselves, business opportunities that would materialize from nowhere. The beauty of Lucky's Wall Street strategy was that it required no initial investment. Traditional corporate takeovers required massive amounts of capital to purchase controlling interests in target companies. Lucky's takeovers required only the ability to solve problems that his targets couldn't solve themselves. Thomas Morrison of Morrison Securities was facing bankruptcy and a federal investigation into his investment practices. Lucky arranged for key witnesses in the federal case to develop sudden memory problems and for Morrison's most aggressive creditors to receive better offers elsewhere. In exchange, Morrison Securities became Lucky's vehicle for legitimate stock market operations. Charles Atlantic of Atlantic Trust Company was being pressured by rival banks who wanted to force him into bankruptcy and acquire his commercial real estate portfolio. Lucky's associates visited these rival bankers and explained why continued pressure on Atlantic Trust would be bad for their own business interests. The pressure disappeared overnight. Atlantic Trust survived, and Lucky gained control of commercial real estate financing throughout Manhattan. James Hudson of Hudson Valley Insurance was losing clients to competitors who were using questionably legal tactics to steal his business. Lucky's organization investigated these competitors and discovered various irregularities that required immediate attention from regulatory authorities. Hudson's competitors found themselves too busy dealing with investigations to steal clients. Hudson Valley Insurance prospered, and Lucky gained access to the insurance industry. Each acquisition followed the same pattern: identify a desperate businessman, offer a solution that only Lucky could provide, accept equity and control in exchange for services rendered. Within 6 weeks, Lucky had assembled a portfolio of legitimate businesses that would have cost millions of dollars to purchase through conventional means. But Lucky's Wall Street conquest wasn't just about acquiring businesses. It was about fundamentally changing the relationship between organized crime and legitimate finance. Previous generations of criminals had treated legal businesses as sources of protection money or money laundering opportunities. Lucky treated them as partners in a comprehensive economic strategy. The financial elite who became Lucky's partners weren't victims or fronts. They were collaborators who gained genuine value from their association with his organization. Their businesses became more profitable, their problems disappeared, their competitors faced unexpected difficulties. Lucky provided services that no legitimate business could provide: absolute discretion, permanent solutions to complex problems, and the kind of leverage that came from understanding both legal and illegal approaches to business challenges. The 29th of October, 1934, marked the culmination of Lucky's Wall Street strategy. 5 years after Black Tuesday had destroyed the American economy, Lucky held a private meeting in the boardroom of J.P. Morgan and Company. The meeting wasn't scheduled on any calendar, announced in any newspaper, or recorded in any official minutes, but it would determine the future of American finance. Present at the meeting were the heads of 13 financial institutions that Lucky now controlled through his debt forgiveness operations. Also present were representatives from 5 banks that were still independent but facing the same pressures that had forced Lucky's other partners to accept his assistance. Lucky sat at the head of the conference table, not as a guest or supplicant, but as the man who now controlled more Wall Street capital than any individual in American history. He had achieved this position not through inheritance, education, or legitimate business success, but through the systematic application of organized crime principles to financial markets. "Gentlemen," Lucky began, "we need to discuss coordination." The word sent chills through every banker in the room. Coordination in financial markets typically meant price fixing, market manipulation, and other activities that attracted unwanted attention from federal regulators. But Lucky wasn't talking about illegal coordination. He was talking about something more sophisticated: the creation of a shadow financial system that operated within legal boundaries while serving interests that legal businesses couldn't address. Lucky's coordination proposal was revolutionary in its scope and subtle in its implementation. The 13 financial institutions under his control would begin sharing information about investment opportunities, regulatory challenges, and competitive threats. They would coordinate their responses to federal investigations, their approaches to difficult clients, and their strategies for managing political relationships. More importantly, they would begin offering specialized services that mainstream financial institutions couldn't provide: loans without extensive documentation requirements, investment opportunities for clients who preferred privacy over publicity, insurance coverage for businesses that operated in legally ambiguous areas, banking services for organizations that needed discretion more than they needed regulatory approval. This wasn't money laundering or financial fraud. This was the creation of an alternative financial system that served clients who were poorly served by mainstream banks, insurance companies, and investment firms. Lucky had identified a market segment that legitimate businesses were afraid to serve and had built the infrastructure to serve it profitably. The 5 independent banks that attended the 29th of October meeting were given a choice: join Lucky's coordination system voluntarily, or face the competitive pressures that had forced his other partners to accept his assistance. 2 of the banks agreed immediately. 2 others requested time to consider their options. One bank, First National Trust, declared that they would never compromise their independence for criminal associations. First National Trust's decision proved costly. Within weeks, they were facing a series of unexpected problems. Key clients transferred their accounts to competitors. Federal regulators launched investigations into their lending practices. Newspaper reporters began asking questions about their involvement in failed investments. The bank's president, William Sterling, initially blamed bad luck and business competition. By December 1934, Sterling realized that his problems weren't coincidental. First National Trust was being systematically destroyed by forces he couldn't identify or combat. When Sterling finally requested a meeting with Lucky, he discovered that joining the coordination system would now cost significantly more than it would have in October. The meeting took place in Sterling's own office, but Sterling wasn't in control. Lucky arrived with 2 associates and a briefcase containing detailed files on Sterling's bank, his personal finances, his family's business interests, and his political connections. The message was clear. Lucky knew everything about Sterling's operations, while Sterling knew nothing about Lucky's. "William," Lucky said, settling into the chair across from Sterling's desk, "your bank has been having difficulties." Sterling nodded miserably. First National Trust was hemorrhaging clients and facing regulatory investigations that threatened its survival. "I understand you've reconsidered our previous conversation about coordination, Mr. Luciano," Sterling said carefully. "I am prepared to discuss mutually beneficial arrangements." Lucky smiled. "William, the terms have changed. In October, I was offering partnership. Now I am offering acquisition. Your bank will become a wholly owned subsidiary of my financial network. You'll remain as president, but operational control transfers to my organization." Sterling wanted to refuse, but First National Trust was already dying. Lucky's acquisition offer was the only way to preserve jobs for his employees and some vestige of his family's banking legacy. "What guarantees do I have?" Sterling asked. "That my bank's reputation will be protected, William," Lucky replied. "My organization has been protecting reputations for years. Your bank's reputation will be safer with us than it ever was on its own." Sterling signed the acquisition papers that afternoon. First National Trust became the 14th financial institution in Lucky's Wall Street empire. By January 1935, 3 months after his first meeting at J.P. Morgan and Company, Lucky Luciano controlled banks, insurance companies, securities, firms, and trust companies with combined assets exceeding $50 million. He had achieved this control without spending money he didn't have, without borrowing against assets he didn't own, and without violating any major federal banking regulations. The transformation of Lucky's organization from a criminal enterprise to a financial conglomerate was complete. But it wasn't obvious to outside observers. The banks still looked like banks. The insurance companies still looked like insurance companies. And the securities firms still looked like securities firms. The only difference was that they all served clients and pursued strategies that mainstream financial institutions wouldn't touch. Federal banking regulators were aware that something unusual was happening on Wall Street, but they couldn't identify anything specifically illegal. The banks under Lucky's control were actually more profitable and stable than many of their competitors. Their loan default rates were remarkably low, their insurance claims were processed efficiently, and their investment returns were consistently above market averages. What regulators didn't understand was that Lucky's banks could offer services that mainstream banks couldn't provide, because they had access to collection methods that mainstream banks couldn't use. When someone defaulted on a loan from one of Lucky's banks, the collection process involved more than phone calls and legal notices. Insurance claims were processed quickly because fraudulent claims were discouraged through methods that didn't appear in any insurance industry manual. The Federal Bureau of Investigation opened an investigation into Lucky's financial activities in February 1935. But they struggled to identify anything prosecutable. Lucky's banks were operating within legal boundaries, their transactions were properly documented, and their business practices appeared legitimate. The fact that these businesses were controlled by America's most powerful crime boss was suspicious, but not illegal. FBI agent Harold Morrison, no relation to Morrison Securities, spent 6 months analyzing Lucky's financial network and concluded that it represented a new kind of criminal organization. Subject Luciano has effectively legitimized his criminal enterprise by acquiring control of legitimate businesses. Morrison wrote in his report, "Traditional law enforcement approaches are inadequate to address this type of financial criminality." Morrison's assessment was correct, but incomplete. Lucky hadn't just legitimized his criminal organization, he had criminalized legitimate finance. His Wall Street empire operated according to organized crime principles, while maintaining the appearance of respectable business practice. The long-term impact of Lucky's Wall Street conquest extended far beyond his own organization. Other crime families began studying his methods and attempting to replicate his success in different industries. Frank Costello moved into real estate development. Meyer Lansky expanded into casino operations in Cuba and Las Vegas. Bugsy Siegel invested in Hollywood entertainment businesses. More importantly, Lucky's integration of organized crime and legitimate finance created precedents that would influence American business for decades. The idea that financial institutions could serve clients who were poorly served by mainstream businesses became the foundation for entire industries: offshore banking, private investment, alternative financing, and specialized insurance. Lucky's Wall Street partners prospered under his protection and guidance. Harrison Rothschild III rebuilt his family's banking fortune and eventually became one of New York's most respected financial leaders. Thomas Morrison expanded his securities business into international markets and accumulated a personal fortune that dwarfed his pre-depression wealth. Charles Atlantic's Trust Company became one of Manhattan's premier commercial real estate firms. These men never spoke publicly about their association with Lucky Luciano, but they never forgot the lessons they learned from their partnership with organized crime. Business success, they discovered, wasn't just about making smart investments or building good relationships. It was about understanding power, managing risk, and solving problems through any means necessary. By 1940, 6 years after his Wall Street conquest, Lucky Luciano was serving a prison sentence on prostitution charges that everyone knew were politically motivated, but no one could prove were false. But his financial empire continued operating under the management of trusted associates who had learned his methods and shared his vision. The banks, insurance companies, and securities, firms that Lucky had acquired through debt forgiveness, continued to prosper. They served clients who needed financial services that mainstream institutions couldn't provide, and they did so profitably and discreetly. Lucky had created a shadow financial system that served the American economy's hidden needs while generating enormous profits for his organization. Federal investigators continued studying Lucky's financial network throughout the 1940s and 1950s, trying to understand how organized crime had penetrated legitimate finance so thoroughly. They discovered that Lucky's success wasn't based on corruption or illegal activity, but on providing valuable services to clients who were underserved by conventional businesses. Lucky Luciano had proven that the most effective way to conquer an industry wasn't necessarily to compete with it, but to solve problems that it couldn't solve. He had turned Wall Street's greatest weakness, its vulnerability to financial pressure, into his greatest asset. He had built an empire, not through violence or intimidation, but through understanding that desperate people would trade anything for effective solutions to desperate problems. On the 29th of October, 1934, Lucky Luciano walked into J.P. Morgan & Company, carrying nothing but a briefcase and a reputation. He left owning a financial empire worth millions of dollars. He hadn't spent money. He didn't have because he had discovered something more valuable than money: the ability to make other people's problems disappear. The Wall Street coup proved that Lucky Luciano was more than America's most successful crime boss. He was a revolutionary business strategist who had fundamentally redefined the relationship between legitimate and illegitimate enterprise. He had shown that the line between legal and illegal business was less important than the line between problems and solutions. And on Wall Street, Lucky Luciano was the solution to every problem that money couldn't solve.